Well, Hinge Health is falling after hours despite beating street expectations for third quarter revenue and fourth quarter guidance, but just giving back just about all of today's gain. Joining me now in a CNBC exclusive, Hinge Health CEO Daniel Perez. Daniel, right before the call, too, so let's get to the meat of this. Strong growth here, and as you guys are looking at issues of back health, joint health, what is allowing you to move ahead of expectations?
Well, look, our strategy for automating care delivery is working. Clients are buying the product, people are using it, and the Q3 numbers back it up, despite what you might be seeing in the after hours. And we've also built a very incredibly efficient business. You can see that in our 53% free cash flow margin, and we're rapidly approaching GAAP profitability. And as a business, we are committed to growing both revenue and managing the business to GAAP profitability.
So you just launched this movement analysis and Hinge score that's going to give, I guess, more information about how patients are moving. What's that going to do to drive demand? How is that going to impact your growth prospects going forward?
Great question. So look, as a reminder, our flagship product offers people digital physical therapy right through their phone. So they can speak to a physical therapist, they can do their exercises right from home, and we're essentially using technology to automate and scale what is our largest services industry in America, healthcare. And so you're right, we launched two actually new AI initiatives this past quarter. Robin is our always-on AI care assistant. This helps members with immediate support, starting with pain flare-ups, and this makes our service a lot more convenient for people, allows them to engage more efficiently, as well as improves our cost profile. And our movement analysis is really interesting in that there's a lot of measurement tools to track clinical outcomes in orthopedic care. And while valuable, most rely on subjective questions, how's your pain trending, how's your stiffness? And our movement analysis uses advanced computer vision, just using the front-facing camera on your phone to capture joint angles, symmetry, and endurance across a short battery of movements to produce a first-of-its-kind Hinge score. And that allows us to combine objective outcomes as well as subjective outcomes that are comparable over time and gives people, as well as their care team, a more complete picture of their health.
So, Daniel, your client base grew 25% year over year to 2,560, but your revenue was up 53%. How should investors think about the degree to which client base grows revenue, and if you're growing, I guess, dollar share of wallet among those customers over time?
Great question. So there's three key drivers to our revenue. It is the number of people with access, and our clients have been roughly the same size this year as they were last year. So when we add new clients, more people gain access to Hinge Health. And secondly is how many people are enrolling in those clients. And then thirdly is our ASP. And ASP has been roughly flat year over year. And so as we add new clients, we're also improving our enrollment rate, and we're engaging people for a longer period of time. Our enrollment per client is hitting all-time highs. And our engagement per person who then enrolls in our program is up substantially this year, and it was up again last year. And so we're making really good progress with our product. People are enrolling at record numbers, and they're engaging at near record numbers as well.
Finally, your revenue guide for Q4 is up year over year, 33% at the midpoint. Is there a slowing happening here, or a careful guide? What's accounting for that particular percentage?
That's a great question. Q4 typically for us seasonally is a little bit of a lighter quarter because of the holiday season. We don't enroll as many people in Q4. Now, what makes this a bit of a difficult compare relative to last year is that we had a really strong Q4 last year, which is unseasonable, and so it just makes it a little bit of a more difficult compare in this Q4 versus last Q4. But our aim is to continue to execute, so we continue to beat our numbers.